Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. We're talking about everything mortgage and real estate. So we're going to get back down to the foundations of mortgage lending and what it takes to get a loan. And we're going to talk about debt to income, or DTI, one of the absolute biggest calculations that a lender is going to do, and I'm going to help you understand more about it. Before we get into that, hit that like, hit that subscribe. I would be forever grateful. Hit that bell icon, and you'll be notified every single time a new video is coming out. Now, I also want to give you an update on where we're at in the market. It's late May 2021. Our average 30-year fixed, according to Freddie Mac, is at 3%, 3.0. All right, so where does that equate over the last few weeks? So we are slightly up over the last couple weeks, but that was down after about 4 or 5 weeks. Basically, where we're at today is the same place we were at late July of 2020. So basically in July of 2020, or really pandemic levels, we started to see rates trend down, down, down. So about July is where we're at that 3% flat. We saw it bottom out into January of 2021, and then we saw it spike up a little bit into, say, March, April, and now we've seen it slightly come back down into May. So hopefully that gives you a good illustration of kind of where we're at. No matter what pandemic era, whatever we're talking about, whatever mortgage environment, that debt to income ratio is really our key factor in qualifying clients for the loan. There's a lot of information that goes into it, but this is really a key factor. So what we want to talk about, DTI, debt to income. It is a percentage. It's the amount of debt you have on the books per the lender on a monthly basis versus the amount of income. So let's first talk about the income. That's probably the easiest. That is gross income. Gross. So that means before taxes are coming out, if you're maxing out 401ks, if you've got all this other stuff, you got all the health benefits coming out, and you're only making a percentage or whatever else. If the household income is $10,000 per month, before all that stuff comes out, we're using $10,000 per month. To use easy math, let's use 10K as our income for our example today. Now, let's talk about debts. What exactly are the debts? So how about your cell phone? How about, the timeshare, this, that? Basically, as we can kind of simplify it, is that it's the minimum monthly payments, or the monthly payments that fall on the credit report. That's really what the lenders care about. So you're going to look at minimum monthly payments on the credit cards. I'll say again, minimum monthly payments, not the balance, the minimum, not what you're paying if you pay it off in full. If the minimum monthly payment's $35, likely that's $35 again. So every program is a little bit different. You've got to apply to be able to see what options would be available for you. So minimum monthly payments on credit cards. You've got potentially car loans, right? So you got installment loans or car loans, maybe personal loans. Obviously, that's coming off. You've also got, say, student loans. That's a big one. So every program, every kind of mortgage program will potentially look at student loans differently. Right now, in 2021, a majority, if not all, are in forbearance, likely coming out very soon. So typically, there is some sort of calculation that we're going to use on that balance for the monthly payment. If that's 1% of the overall balance, 0.5%. Or maybe we're using the actual payment that shows up on the credit report. But that is one of those gray areas that's a little bit different with each program. So the last piece of the debt, and maybe you're not thinking about, is the new home. Or if you're refinancing, the actual principal, interest, taxes, and insurance, and then any HOA fee. So if you think about your payments, $2,000 for your home, all right? Now you've got a car loan for $500. You've got some other debt that totals maybe $1,000. You've got your house for $2,000, okay? So we've got $3,000 of debt. You make $10,000 a month. Your debt to income ratio is 30%, okay? So that's the back of the napkin math. It's a really easy way to look at it. If you're falling under 40%, you're literally going to have every program available. Now, again, you've got to apply to be able to see what is available for you. And obviously they go through in terms of credit and all these other items, FICO scores. But with that said, just back in the napkin math, you want to be underneath 40. Some programs may be able to take you up above 50. But typically if you're below 40, your average you really want to look at is around 33%. So that's typically the case where you're going to look at and say, hey, now I know exactly what I can afford. So this is Debt to Income. This is Ryan Skaggs with the Mortgage Minute. Thank you so much for tuning in, and we'll see each other again very, very soon.